On today's episode, we are going to take a look at two streaming giants that have taken a huge hit, and may I say both of these are monsters in their space and they could be giving us buying opportunity. Like always, for each stock we're going to take a look at future growth, fundamentals, technical analysis, and even taking a look at some of their valuation metrics. So let's get started. Alright, so the first company we're going to take a look at is Spotify. This is the audio streaming platform, and there is a high chance if you're listening to my podcast, you are listening through Spotify. So right now, Spotify is traded under the New York Stock Exchange as ticker SPOT. It's currently sitting at $240, and as I am recording this episode, the stock is down about 0.85%. But if we take a look from its 52-week high, the stock has seen crazy corrections, is down almost 34%, and it currently has a market cap of $45.66 billion. Now, if we take a look at future growth, this company is expected to grow 16.6% on average for the next 2 to 5 years. So this is a nice hyper growth stock. Unfortunately, Spotify right now is not profitable, but they are positive in cash flow from operations, and that's definitely one thing I like to see. Next, if we take a look at their balance sheet, it looks pretty impressive. They have about $3 billion in cash and short-term investments and about $1.2 billion in debt. Most of that debt is due to a $1.3 billion exchange senior notes offering. So I'm really liking their overall balance sheet. I'm liking their fundamentals. Some other things I enjoy about Spotify is even though their market cap is over 40 billion, their CEO and founder still owns about 8% of the business. Before we take a quick look at some more fundamentals, if I am providing some form of value, make sure to hit the thumbs up and subscribe to the channel. It really does help a lot. And let's take a quick listen to today's sponsor, a good reason why I'm able to provide so much content for you guys. I want to thank the Motley for sponsoring this video. The Motley is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You guys know I love finding new investing tools and resources to help me scout out new growth stocks. And right now I have a discount for one of my favorite services the Fool offers. Through the Motley Stock Advisor services, you get access to a ton of expert stock picks. Every month you'll get 2 new picks that are aimed at growing your wealth and to help you realize your financial goals. Stock Advisor's average stock picks have done amazing returns. If growing your money is something you'd like to do more of this year, you can visit fool.com/Jose Najarro or click on the link below for access to my special offer and decide if the Stock Advisor is right for you. Thanks again to the Motley Fool, and now onto today's video. And here I just want to show you how much of a historical growth monster Spotify has been. In 2020, they grew their revenue 26%. In 2019, 25.7%. In 2018, 23.1%. In 2017, 58%. So historically, this has been a non-stop growth monster. Now, if we take a look at this company's most recent earnings, most of their revenue actually comes from premium content, and this is when they have premium subscribers who pay the monthly fee. About 90%, maybe even more of total revenue comes from that segment. Now, if we take a look at users, they did see an increase of total monthly active users by 24% compared to the same time last year. That's good, but what I really want to see is premium subscribers. Premium subscribers grew 21% compared to the same time last year. These are the ones that really make a huge impact for the company's fundamentals. Spotify, I would also consider a nice innovative monster. And this is pretty weird, right? How can you innovate within the audio world? And we're going to see how Spotify is doing that. On March 29th of 2021, they acquired Betty Labs, the creators of Locker Room, a live audio application that's changing the way insiders and fans talk about sports. This will accelerate Spotify's entry into the live audio space. So they're trying to enter different spaces already within the audio market. In February, they did announce a partnership with Anchor and WordPress. The other one I really want to talk about is they also launched a joint partnership with Facebook to create an integrated ecosystem where people who want to listen to music in their social platform don't have to jump across applications. Now, if we take a look at the full year guidance of 2021, I do believe this is one of the major reasons the stock price has taken quite a hit. They did lower their total monthly active users for the full year because in this most recent quarter, they did see lower growth. But their premium subscribers, and remember, their premium subscribers is where most of the money comes, remains unchanged. Total premium subscribers for the full year remains about 172 to 184 million, where right now in quarter one is sitting at about 158 million. So they're still expecting strong growth in that market, which means we're still going to expect strong growth in revenue. The second company we are going to take a look at is Netflix, the live streaming monster. I'm pretty sure I don't have to explain much about Netflix except the fundamentals. So this is traded under the NASDAQ as ticker NFLX. It's currently sitting at $490.95. From its 52-week high, the stock has seen about a 16.3% correction, and it currently has a market cap of $217.7 billion. So this is a giant nonetheless. Future growth, this company is expected to grow 13.4% on average for the next 3 to 5 years. So even though it's already a monster, it's still expected to continue that growth. Something I enjoy about Netflix right now is they have finally become positive in cash flow from operations. This is super impressive in my opinion. They're also profitable in earnings, and you can see that huge revenue growth. If we take a look at their balance sheets, they have about $8.4 billion in cash and short-term investments and about $15.6 billion in debt. Remember, this is a company that is positive in earnings. They are positive in cash flow from operations. So even though their balance sheet does seem a bit leveraged, I would say it's not something that would worry me as an investor. I do not have a position in Netflix, but if I did, this type of balance sheet wouldn't worry me because of the rest of the fundamentals. If we take a look at historical growth, very similar to Spotify, the past 5 years, this company has grown like crazy. 2020 grew 24%, 2019 grew 27.6%, 2018 grew 35.08%, 2017 grew 32.4%. So historical, a growth monster even before COVID-19. Other things I am enjoying about Netflix is if we take a look at their trailing 12 months gross margins and profit margins, both of them seem to be uptrending. Right now, gross margins are about 41.1%. Profit margins for Netflix in trailing 12 months were 14.2%. Now, if we take a look at their most recent earnings, I want to say this is probably one of the biggest reasons the stock price has taken a nice hit. Right now, it seems like their growth in paid membership is slowing down, where previous quarters it was growing over 20%. In the most recent quarter, it grew 13.6%. So this is quite a disappointment for Netflix. And then the forecast they gave for quarter two only expects an 8.1% year-over-year growth. But we do have to keep in mind that COVID did accelerate a bit of the growth for this company. I mean, here we can see the charts of how COVID has helped out this company and how it kind of accelerated the growth for the full year of 2020. And now it does seem like 2021 is going to be a slow year for Netflix. They do mention that good portions of their shows do show up in the second half of the year. So investors should definitely keep interest on how they guide for quarter 3 and quarter 4. Now, if we take a quick look at technicals, I just want to make sure they're not overextended. First, Spotify. I think Spotify is actually sitting at some nice levels next to its long-term moving average. Definitely not overextended. Netflix is not overextended, but it's not beat up as Spotify. So in forms of technicals, I do like Spotify a little bit more. I believe a good portion of the risk has been eliminated. Obviously, the stock can continue to go down. Now, if we take a look at valuation metrics, I'm taking a look at forward price to sales ratio. The first thing you guys might notice is that Spotify is a lot cheaper than Netflix. That is going to be the case because Netflix has higher gross margins than Spotify. So here I want to take a look at them individually. Right now, Spotify is sitting at a price to sales ratio of 3.3. These are levels last seen somewhere in June, July of 2020. So now if we take a look at Netflix, is sitting at about a forward price to sales ratio of 6.359. And these, again, very similar to levels last seen in June of 2020. Overall, they're still pretty high from pre-COVID levels, so let that also be in mind. But I do believe a good portion of the risk has been eliminated for both these companies. All right, so now let me share my overall thoughts. Spotify is in my portfolio, Netflix is not. Spotify is going to continue into my portfolio as a tier 2 stock. I'm just very, very bullish in the overall audio market. We saw strong fundamentals, we saw strong growth, and it has seen a nice pullback in technicals. So I'm not planning on buying Netflix, but if it was to ever be in my portfolio, I do believe it would also be in a tier 2 stock level. So I hope you guys enjoyed today's episode. Like always, take care, have a good night, and see you next time.